This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Businessweek Daily. Very good afternoon, everyone. Happy Monday. I'm Tim Stenovec. That is Norah Mulinda. She's in for Carol Massar this afternoon. It looks like equities pulling back a little bit. The exuberance that we saw on Friday taking a little bit of a breather. We got a big week coming up when it comes to economic data, when it comes to semiconductors. And we're kind of going all in on all of the above there. Ian King is standing by. We're going to be getting to him in just a second. Also, we're going to the skies to talk global aviation.
Absolutely. We're going to be getting a check on global aviation, on planes with Boeing, and on how much people are traveling. And of course, we're going to do all this with the woman in charge at Pittsburgh's airport. Also,
an update on real estate with the folks over at Walton Global. They kind of sit in a really interesting position when it comes to real estate, serving as the middle entity between the home builders and the folks selling that real estate. So a good temperature check of the industry. All that and more coming up over the next 1 hour, 3 hours. We got a big show today. All that coming up. Here is Charlie Keller.
Right, thank you very much. Welcome back. Happy Monday with the Dow, the S&P. They are in the red. NASDAQ continues to push higher. The NASDAQ Composite Index up 39 now, up by about 0.2%. Right to the numbers. S&P down 8, drop there of 0.2%. We do have the Dow lower by 264 now. That is a decline of 0.6%. A rally that puts stocks on the brink of record sputtered. Bond yields rose as euphoria around Fed rate cuts eased ahead of a key inflation reading this week. Right now, we've got the 10-year 4.26%, the 2-year 3.73%. Gold flat on the day, $33.71 the ounce. West Texas Intermediate crude rallying 2.1%, $64.97 the barrel. And Bitcoin down 0.4%, $112,300 on Bitcoin. Elon Musk is accusing Apple and OpenAI and a lawsuit of unfairly favoring OpenAI across iPhones and thwarting competition for other chatbot makers. Shares of Apple right now, Apple shares trading a little changed on the day. We do have the S&P lower by 0.1%. Cannot ignore the Mag 7 index up now by 0.8%. Again, recapping here, S&P 500 index down 0.1%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Certainly do appreciate it. I said we're going all in on semiconductors, and I mean it because there's a lot happening in the space. Nvidia reporting on Wednesday. It's closely watched because it has the potential to move markets. We're going to go all in on coverage on our program on Bloomberg TV when those numbers do cross. Also closely watch what's happening with Intel now that President Trump sealed a deal giving the U.S. government a close to 10% stake in the chip maker. Here's the president in the Oval Office this morning weighing in on this unconventional deal.
I invest my heart in it and my soul because I want the country to be strong. But I said, I'd like you to give 10% of Intel to the United States of America. Not to me, to the United States of America. And I said, if you have them as a partner, you have the United States as a partner, I think that would be a very good thing for Intel. And he thought about it, a little bit different, and he said, I like that idea very much. We have a deal. And I just made $10 billion or $11 billion for the United States of America. And yeah, there will be other cases. If I have that opportunity again, I would do that. And then, you do have stupid people say, oh, that's a shame. It's not a shame. It's called business.
That was President Trump earlier today in the Oval Office at the White House. The president says he will, quote, help those companies that make such lucrative deals with the United States. He made a comment earlier on Truth Social about this. I want to bring in Ian King. He's Bloomberg News U.S. semiconductor and networking reporter. He joins us from the Bloomberg San Francisco studio. Ian, you've been out for a few days, so we haven't actually had the chance to talk to you about this story yet. I want to start with the fundamental question about the health of Intel and to what extent a U.S. government stake will actually change that at all. Will a U.S. ownership stake fix Intel's woes?
Yeah, I mean, that's the heart of the matter, and that's what we've been delving into. So if you look at how the analysts have reported on it and what the fundamental agreement, which Intel made public this morning, say. Frankly, the money is kind of money that they were lined up to get anyway. What's good for them is arguably that they're no longer tied to this program where, hey, we have to build a certain amount to get a certain amount of money. So that's good. So they, in theory, according to the agreement, they can use this money for whatever purpose they need it for. But in terms of the actual amount, in terms of their requirements to be what they really want to be, no, it's not enough. $8 billion is a lot to you and me. But for Intel, when you're building a plant that costs more than $20 billion and is obsolete within 5 years, it's probably not enough to completely change the picture in a way that I guess investors would want.
Mm-hmm. Ian, how would they use this money differently, especially, if they're no longer tied to the CHIPS Act?
Yeah, I mean, we don't know is the answer to that because they haven't said, and I'm guessing that they're going to be very careful with what they say. What the US government wants is this giant new chip plant in Ohio to go ahead, right? That's what they want that money to be. They haven't said it explicitly, but that's been the push. What Intel wants and what Wall Street wants is what the CFO said, which is our balance sheet is not in a good position. We need to do something about that. We need to focus on that. We need to improve our designs. We need to improve our manufacturing technology and play catch up. But there's a gap there, right? So we'll have to wait and see. We'll have to hear whether there were some kind of background agreements and understandings put in place. But so far, based on the black and white, they can use it for whatever they want.
The president, Ian, saying in the soundbite we just heard, quote, I just made $10 billion, $11 billion for the U.S. That's just part of what he said in the Oval Office. I know we don't completely understand how this deal works, but as the U.S. government being an investor in this storied U.S. firm, we'd only, and I'm speaking as the U.S. people, right? We, as Americans, would only make money if we exit that investment at some point. Certainly there's dividends, or potential for dividends. Certainly there's appreciation, potential for appreciation. There's also downside risk here as well. How does the U.S. government and therefore the U.S. people make money on a deal such as this?
Yeah, no, that's a very good question. I'm a taxpayer too. I want to know. So first of all, there's no dividends. Remember, Intel, because of its financial situation, stopped paying dividends, which is not something that obviously investors enjoyed particularly, and they're suspended until Intel's finances improve. But yes, you're absolutely right. The only way that you and I as taxpayers make money out of this deal is if Intel is able to turn its fortunes around and investors get behind it and the stock price goes up. Right now, we've bought a chunk of a company that is not in the greatest position and nowhere near where it used to be.
So what does this mean for not only Intel, but other firms and potentially the idea of the U.S. taking a stake here in Intel? What is the broader read-through here?
Yeah, well, the broader repercussion, and I think the derivative here is what Intel needs more than anything else are customers, outside customers. Right now, basically, the main customers for all of these expensive factories are its own products. Intel's big push, and the reason why I wanted to spend so much money was because we want outside customers, because we want Nvidia to give us orders, because we want AMD to give us orders. So far, that just hasn't happened. So what's going on behind the scenes here, and what we're hearing is that, at least from the analyst reports, is that unless Intel can get these external customers, as it said itself, unless maybe Donald Trump, who's very good at deals apparently, can get Nvidia or get anybody that's a major chip maker to give Intel these orders, then really not a lot has changed. So again, it's horrible to keep saying we don't know, we'll have to wait and see, but I think we need a second or a third act in this whole arrangement for it to be really meaningful for Intel.
Okay, you said Nvidia, so that's where we're going now, Ian. It's the world's biggest stock. It makes up 3% of the global market cap of all public companies. It's a shocking stat to think about. The remaining 97% comes from 82,551 stocks. That's just how big of an impact Nvidia has on global markets. What do we need to know ahead of Wednesday's report?
Yeah, I mean, what I would say is the impact is even greater than that. If you look at the S&P by size of companies, the next 5, 6, 7 companies, which, stick them all together and they'll look almost to a quarter of the value of the S&P. these are all related to Nvidia. They're all AI stories. They're all related to either the companies that are spending on AI or companies that are profiting from that spending on AI. So what Nvidia can tell us, whether spending is still strong, whether demand is still strong, whether AI is spreading throughout the economy, is absolutely essential to an even bigger part than Nvidia represents itself. And I think that's why people are so on edge and so focused about this in terms of what Nvidia can say. Of course, the story is, are we still spending? Are we still growing? I mean, growth is, I was looking at the numbers, growth is probably going to slow to 54% for this projected quarter, which, oh dear, that's horrible, right? But, because last quarter it was 69%. So that sounds like a slowing, but you've got to remember it's on course this year in terms of revenue. If it hits the targets that Wall Street set for it, it'll be basically a third of all sales of semiconductors worldwide. So, I mean, the numbers are just, we could go on and on all day, but what people really want is this fundamental confirmation of, hey, everything's okay, people are still spending.
Hey, Ian, valuations for many AI firms are at nosebleed levels. Essentially, that's how a source from the story that ran over the weekend from our colleagues Carmen Reinecke and Jess Minton said from Stewart Partners here. Are expectations high heading into this report? What is this really going to illustrate in terms of the broader AI scope, really?
Yeah, I mean, valuations is something that obviously the market decides, right? What they're comfortable with, what levels they're at. And obviously we can look at the percentages, the PE ratios and the projected, but for us, I think the best way to look at it is how fast has this company come? Has it justified this big run-up? We've not seen anything like it in terms of the valuation run-up, but on the flip side of it, we've not seen anything like it in terms of run-up, in terms of the revenue, in terms of the profitability. This year, it's going to have a net income on a GAAP basis of $99 billion, right? 3-4 years ago, total revenue, when it hit $25 billion, that was a victory lap. So this is unprecedented territory. So can you put a normal valuation on that? I don't know. You decide. It's for the investors to decide. But the numbers that it's projected, and if it can continue at this pace, and it looks like it is, then I think we're in a territory that hasn't been explored before.
Well, we are grateful to have you as a leader exploring it with us and actually helping us make sense of it. Ian King, he's Bloomberg News U.S. semiconductor and networking reporter out there in San Francisco. Nvidia earnings, not the only big event happening this week. Tomorrow, we get an update on durable goods orders. Consumer confidence as well from the Conference Board. Thursday, we're going to get U.S. GDP. And on Friday, watch for core PCE. That's just some of what's going on, some of the data to keep an eye on. Watching it all and more, Jennifer Lee, senior economist and managing director of economics for BMO Capital Markets. The firm has just over $1 trillion in assets under management. Jennifer joins us from Toronto. Jennifer, we're going to get to all of this data, but I want to start with your takeaways from Jackson Hole. For a week ago, we were sitting here saying it's all about Friday, it's all about Friday, it's all about Fed Chair Powell's speech. We got that. Markets breathed a sigh of relief. There was a relief rally. That euphoria around rate cuts certainly easing. What were your takeaways?
So first of all, good afternoon, and thank you very much for having me on. And full disclosure, I was actually one of the few people that thought, oh, he's not going to say anything. What is he going to possibly say? He's going to sort of stay safe. And I was pleasantly surprised. And that's one of the positives that I took away on Friday, just not just getting some clarity on the trade front, but getting some clarity on where we see monetary policy going. And he certainly did hint toward a rate cut. He didn't say anything, I don't think, beyond that, but it certainly looks like he is becoming more comfortable with a September rate cut. And again, just to use phrases that have been used so many times over the last number of years, we're going to be data dependent. It's going to depend on a meeting by meeting basis. But he was talking about how, the dual mandates are being, it's sort of difficult to wrestle with both dual mandates right now. But there is more of a downside risk coming from the job side, and he's not as worried, it seems now, from the inflation side, which is kind of interesting. So anyway, definitely more comforted knowing that at least he is starting to think about rate cuts. And although, President Trump did say it was too late, but at least, again, we know that it is most likely going to come data dependent. We still have a few more numbers, by the way, as you mentioned, to keep an eye on before that September 17th date.
Jennifer, he's certainly becoming more comfortable with the idea of a rate cut as you're laying out here for us and what we saw last week. Where do you see monetary policy going? Are you expecting a rate cut next month? What's the cadence afterward, if so?
So we haven't changed our forecasts much at all over the last little while. We continue to see 2 more rate cuts this year, September and December, 25 basis points each, and about 4 next year, probably on a quarterly cadence theme, I guess, like 4 times next year, so and 2 more times this year. So that's sort of how we see the economic landscape playing out right now. Of course, lots can change depending on how some of these trade deals go, depending on how inflation pans out, what's happening on the jobs front as well. But right now, I think it's a pretty fair, safe sort of, bet to take that, a couple of this year. Although I don't think every single Fed policymaker is on board with that.
The president late on Friday said the U.S. is conducting a, quote, major tariff investigation on furniture coming into the United States. Just when you kind of thought that there was a little bit of clarity when it came to what was happening with tariffs, there's a new element thrown into this. How big of an effect does that have, in your view, on just the way that countries are thinking about the United States as a trading partner?
So I guess it just suggests that, and again, full disclosure, that wasn't even on my radar, furniture, but it sort of
you and me both, I'll be honest.
It sort of leans into the whole lumber and steel, tariff category, but it just gives us a reminder that nothing is off the table in terms of tariffs, and if they are deemed to be, a possible source of national security or whatever, or there's some type of unfairness kicking in, then yes, it's going to be the focus, or one of the is going to be one of the things that the administration is going to focus on. So we can't get too comfortable with it. And it also suggests that, potentially in the inflation story, we might start seeing those stronger inflationary pressures perk up again in coming months. Because I think there's like 50 days, I believe, that the administration said that they're going to take to start to study this sector. And if all is found to be in order or not in order, then you can see tariffs being thrown onto the furniture sector. So again, we could see potentially more inflation playing out. We could see more pressures on the consumer front, and then we're going to have to see how the Fed is going to handle it. Like again, how much of the higher prices will be pushed onto the U.S. consumer, and whether or not the U.S. consumer can deal with it.
Super briefly, do you believe that the U.S. consumer will be able to deal with this? Of course, we saw a lot of data previously. We didn't really see tariffs being baked in there yet.
So far, the U.S. consumer has been holding up, and we've been saying for, 100 years now, never to underestimate the U.S. consumer, and I still stand by that. Of course, at the same time, it's all going to come down to jobs and whether or not there is going to be continued strong demand for jobs, wages, especially. That's the one thing I want to say about the Friday's report on personal income and spending. I want to keep an eye on the wages and salaries component to see whether or not we're going to still see a solid reading. I think of the prior month, it was a very soft reading, which is a bit, disconcerting. So as long as we continue to see steady gains in wages and salaries, consumers will still be able to suck a little bit away for the rainy day, keep the saving rate, around 4% or so. And then they can sort of sit back and maybe wait it out a little bit, but at least they can still, as long as they have a job and they can still afford to buy things, I think the U.S. consumer will be in pretty good shape. And I will also say that this whole 90-day pause that the U.S. now has with China, which brings us to November, I think it's November 10th, sort of also puts off, some of these higher tariffs onto these U.S. products as well. So that's good news on the inflation front, although I did see a headline just flashed in front of me about how President Trump is threatening China with 200% tariffs.
Well, always stay glued. Always stay glued to the terminal for all the latest. Jennifer Lee over at BMO. Coming up next, air travel.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got U.S. stocks trading mixed with the Dow, the S&P. They are lower. NASDAQ, the composite index, up now by 0.1%. NASDAQ 100 index, let's call that unchanged on the day, keeping it all in context. The S&P down 10 now, down 0.2%. The Dow lower by 0.6%. NASDAQ up 0.1%. And our Mag 7 index higher now by 0.7%. The 10-year at 4.6%. 3.26% with a 2-year 3.72%. Gold little changed on the day, up $1 the ounce, 33.72, while West Texas Intermediate crude up 1.9%, 64.88 a barrel, and Bitcoin now down by 0.2%, 112,510 on Bitcoin. Texas-based Crescent Energy has agreed to buy rival shale oil producer Vital Energy for about $733 million. This deal comes as small and mid-sized shale producers are increasingly turning to acquisitions to grow and expand their portfolio of future drilling sites. Buying Vital will give Crescent access to sites across the Permian Basin. Vital shares, they're surging now by 16%. Crescent is down by 4.6%. Recapping, S&P down 0.2% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks for that update, Charlie. Do appreciate it. Boeing CEO Kelly Ortberg's campaign to rebuild the company culture is being put to the test by a rise in labor activism. Boeing and union leaders representing striking workers at its St. Louis area defense factories are set to return to the bargaining table today as they aim to end a 3-week-long impasse. Workers have grievances over pay and pensions that were sacrificed in long-term contracts, and the company faces lingering ill will from its past tactics. We've got with us Sid Phillip, chief correspondent for global aviation for Bloomberg News. He joins us here in the Bloomberg Businessweek studio. Sid, at the heart of the labor issue here, what exactly is it? Because this is focused on the defense portion of Boeing's business.
Yeah, so this is Boeing's defense workers who are on strike. So it's a smaller strike than the one we saw last year when people making the essentially their bread and butter commercial aircraft went on strike, and that was sort of much more hard-hitting for Boeing. This is a smaller scale dispute, but at the same time, it is vitally important because Boeing defense business is in the process of being overhauled, and Kelly Ortberg has talked about how he wants to sort of bring it to a more steady pace of growth, a steady sort of returns, and that's really being put to the test by this stoppage, which is basically affecting output. The lines are still open, unlike when the Seattle strike happened. The lines are still open in St. Louis, but at the same time, output is nowhere near where it should be.
Sid, so it seems as though there's some pretty key requests here that they are looking for here at the union to see that Boeing is able to give them. But we're dealing with a 3-week-long impasse here. Is this long? How long could these potentially be drawn out for?
I mean, the previous strike went on for 99 days, and so this is not the longest strike that the company's faced. At the same time, it is disruptive for the company. It's disruptive to the efforts to turn around the company. And it is disruptive for Boeing because there's just one more fire that they need to fight at a time when they're already fighting many fires.
You know, they're doing a good job, though, I think analysts and investors would say, of combating some of the issues that the company has had. For all intents and purposes, Kelly Ortberg, analysts and investors would say, has done a pretty good job turning the company around, and now it finds itself in this unique position as being essentially this bargaining chip when it comes to U.S. trade.
It does. I mean, Boeing has sort of turned around the corner since its massive. It had the grounding of the 737 following those 2 fatal crashes. The plane came back into service, and last year we had the door plug blowout, which then sort of put back scrutiny on Boeing. We had the strike last year, so Kelly Ortberg has managed to sort of start turning the process of turning the company around. At the same time, the company still has long ways to go before it's actually on a stable footing.
So you say that it has long ways to go. What are you looking for? What are investors looking for here?
So investors are looking for when Boeing will be sort of untapped, but it's the FAA at the moment has capped production of the 737 at 38 a month. They're looking to see where the signs are in terms of being able to go to 42 a month and then potentially go to beyond where they were pre-pandemic. Airbus has talked about 75 a month on the competing A320neo. So this is where Boeing would sort of, in a scenario where they can actually get everything together, that's where Boeing would be.
You and the team last week were for the first to report that Boeing is close to ending its sales drought with China. The story moving Boeing shares as much as 3.7%. Boeing said to be in talks to sell up to 500 jets to China. Is that going to happen?
We're still waiting to see. I mean, a lot of it depends on the trade negotiations that are underway between the US and China. And we understand that any agreement with Boeing would be conditional on some sort of trade agreement being reached. And Boeing has become emblematic of trade agreements across the world. I mean, we saw that with Qatar. We saw that with other deals where Trump touts the Boeing angle of it is as part of the wins for the U.S. And so Boeing has become really crucial to U.S. foreign policy and trade negotiations. And this would be one of the biggest orders and potentially one of the biggest trade negotiations.
Not to mention a 747 that was given to the U.S. government by another country as well. Hey, Sid, always love chatting planes with you. Sid Phillip is a Bloomberg global aviation correspondent, chief correspondent for global aviation here in our Bloomberg Interactive Brokers studio. For more on global aviation, I want to bring in Christina Cassotis, CEO of the Pittsburgh International Airport. We're going to talk to you about the airport update in just a minute, specifically that new terminal and how it's going, setting to open up this fall. First, though, give us an update on how business is shaping up for the summer, because when we spoke earlier in the summer, you gave us the impression that things were looking pretty good.
They were looking pretty good, and they are pretty good. We're actually having our second busiest June in nearly 20 years, but the industry overall is definitely seeing some softness. And I'm confident that on Bloomberg, I've heard you cover airline earnings and what Ed Bastian was saying about, the fact that airlines are having to cut capacity in September in order to get back to profitability is something that we're all paying attention to.
Are you experiencing any cuts in routes to or from Pittsburgh's International Airport?
Yes, we have seen some as a result of Spirit's bankruptcy. Definitely, but that's not unique to us. Otherwise, like I said, we're having a great summer. It's just that we were expecting to have a better summer. Okay. So, we're in good shape. We were expecting more traffic this summer.
So what are the drivers for that, pullback, drop off in traffic here over the summer?
Well, so one of the things, there's no question, there are a lot more schools starting in August, and I think that I agree with Ed Bastian that definitely has an impact on August. I would say that the other thing is that, as we have seen, we were all expecting much more growth in air travel for this year when we were doing our plans. And while as I said, we're flat against last year, we expected to see an increase. And, there's a lot of reasons for that. We're certainly not the only ones experiencing it. We are seeing that globally and nationwide as well. So lots of reasons, I'm sure.
So are you all at all being impacted by the strikes from Air Canada?
We are not being impacted by the strikes for Air Canada. We have had service flying to the markets that we have here, Montreal and Toronto. And that has not been an impact to us directly as of yet.
There's only so much within your control. Yeah, I don't,
that's right.
That I think maybe that's like a mantra that we all should be repeating all the time.
Right,
but I think especially with you, because, you think about it from the perspective of customers, they're not necessarily, the airports it's table stakes, right? They're going to use, especially in a place like Pittsburgh. In New York City, it's like, okay, well, I can choose to fly out of LaGuardia, Newark, or JFK, depending on where I'm going and where I'm coming from. So if you think about it from your perspective, what do you do in a situation where your expectations don't meet reality?
So that is, first of all, that's the job, just to be clear, right? As an airport, we are definitely at the mercy of the airlines and the decisions that they make, as well as our passengers and what's affecting them, their household economies, or what's happening in their businesses. So what we've done is spent a lot of time, candidly, reimagining what the airport can do and be for the community, which is why we have, for as much focus as we have on the day-to-day operation and making sure that it runs safely, that we're building this new terminal, we're demonstrating to our business partners that we are a good business partner for them. We are also investing in a lot of other activities that perhaps airports don't necessarily pay attention to: energy independence, on-site SAF production here at the airport, looking at how we use our facility as a technology innovation accelerator for airlines and airports globally. In other words, how do we participate in the broader economic impact using the facilities that we have? And that has actually been incredibly successful for us. So while passenger traffic will drive the majority of our revenue, we are looking to diversify that revenue stream in order to be able to continue to invest in necessary capital and programs that are really going to make this airport be everything it can be and should be when traffic does return and continues to grow.
Christina, if summer wasn't as good, what are expectations for the fall? Of course, we have a couple holidays, Labor Day right around the corner, Thanksgiving ahead. What are the expectations moving forward in the fall?
We're all watching the major airlines to see what they're going to do with capacity. We're watching Spirit. We're looking at how Southwest is managing in its. I mean, right now we are expecting to continue to not realize what we had budgeted in for growth. So we were looking for 6% this year, and we are expecting to probably stay flat. And that's something that we're working around. At the end of the day, and you know this, you both have been covering this industry for a while, traffic always comes back. It always comes back. And it usually comes back stronger. So what we do is we ride it out and we manage in the meantime.
Hey, we only have about a minute left, and I want to get two more questions in. Sure. First on what happens this winter, and if you're seeing signs of airlines pulling back even more this winter.
Not yet.
Okay. Not yet. So stay tuned for that. We could also see airlines increase capacity, too. It doesn't just go one way.
That's right.
Let's talk about October and the new terminal opening. Still on track for October?
Still on track. We have not set a final date yet, but yes, still on track. We are moving forward with lots of trials and testing, integrated trials, and lots of events for the community and for the industry to let everybody see what they can expect. But yeah, we are so far on track for sometime in October, date to be determined.
What can people expect?
Oh my gosh, it's fantastic. You should come see it. It's
I saw it under construction. It was just walls that I couldn't see into, so I don't know.
Yes, it's different now.
Okay.
So it's actually like nothing else in the U.S. It's beautiful. It's filled with lots of natural light. There's lots of space and lots of good intuitive wayfinding, universal access, space for meeters and greeters. It makes sure that everybody who needs to use this airport as either an employee or a passenger and or a partner is going to get what they need and be able to deliver services to each other rather seamlessly. So it's spectacular in terms of design, and the services we'll deliver, we think, will be far superior to what we're able to do today. A lot of that enabled by technology that keeps people still at the center.
Well, looking forward to checking it out. Christina, always great to check in with you. Thank you, as always, for joining us on Bloomberg Businessweek Daily. Christina Cassotis, she's CEO of the Pittsburgh International Airport. Coming up next on Bloomberg Businessweek Daily, a check-in on real estate with Walton Global.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. A rally that puts stocks on the brink of records is sputtering today. Bond yields are rising as euphoria around Federal Reserve rate cuts eases ahead of a key inflation reading this week. We do have the S&P 500 index lower by 11 right now, has been down all day, 64.55 where we stand, a drop there of 0.2%. The Dow lower by 280, down 0.6%. NASDAQ is up 23 now. That is a gain of 0.1%. Our Mag 7 index is pushing higher by 0.7%. Nvidia, which reports earnings later in the week, specifically Wednesday, up now by 1.9%. 10-year at 4.26% with a 2-year 3.72%. Gold flat on the day, 33.72 the ounce, and West Texas Intermediate crude oil up 1.8%, 64.83 for a barrel of WTI. Sales of new homes exceeded forecasts in July after an upward revision to the prior month as prices eased and heavy incentives enticed more buyers. The median sales price of a new home decreased nearly 6% in July from a year earlier to $403,800, the lowest since 2021. Among home builders, Toll down 0.4%. Pulte little changed on the day. KB Home down now by 1.9%. Recapping, S&P lower by 11, a drop there of 0.2% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet always sets us up perfectly. He knows we're going into real estate. I want to reiterate what we just heard. Sales of new U.S. homes exceeded forecasts in July after an upward revision to the prior month as prices eased and heavy incentives enticed more buyers off the fence. While sales did top projections, the new home market has grown dependent on price cuts and incentives to get customers amid high mortgage rates. Katie Hubbard watches this closely. She's Executive Vice President of Capital Markets at Walton Global. It's the privately owned asset and real estate investment company that has more than $4.5 billion of land assets under management and administration and more than 80,000 acres under management and administration. She joins us from Denver. Walton Global operates in retail, industrial, and commercial. Katie, you were last on with us about a month ago. I'm going to ask you the same question that I asked you at that moment. Is the residential housing market better, worse, or no different than when you were last on our program?
Tim, thanks so much for having me. I would say that it is better. While prices are at $403,000, it is much more affordable to buy a new home now than an existing home. And we're starting to see investors really move into the new home market. In fact, institutional investors reported last year they were buying up about 4% of homes for our builder clients. And now we're reporting 20% of homes are going to institutional investors. That means that they see the value in the new home prices. While there's still a pent-up demand and just high rates, they know that buying now is going to be a good investment for the long term for them.
So what is driving that? Where are we seeing this coming from, especially since if you look at the S&P 500 real estate stocks are in the green so far this year, but they're still one of the worst performing industry groups on a year-to-date basis in the S&P 500. If you dig a little bit deeper into the home building index, they're on pace for their best month since July of last year. So what's really driving this demand here? Because if you think about the average person, they would say that rates are too high.
Right, Nora, that's a great question. So you saw that obviously recently Warren Buffett, nodded to the industry with nearly $1 billion in investment in stock into this sector. And it's really just the fundamentals that are driving this. People need a place to live. And so if you have the pent up demand, knowing that rates, and I think that just looking at the macro rates could be coming down and the demand is there, that just bodes well for the long-term fundamentals. As far as the stocks go, they're still trading really at a great value relatively low PE ratios. And so I think that that's why investors are also looking at this as a good long-term fundamental play.
So remind everybody, we were talking about this on the call, but it's like Walton Global, not necessarily a household name, but a lot of the firms that you sell to are household names. Remind everybody about the space you play in and then also what demand is looking like from those customers.
Absolutely. So Walton, we land bank for public home builders. So we're purchasing the land for them so that they can keep it off their balance sheet. And that is just not a fad or a trend, but that is an ongoing future wave of the home building industry where the large public home builders are doing extremely well because they're holding land off their balance sheet, not tying up their cash. They want to return shareholder equity. They want to turn their money 2, 3, even maybe 4 times. And by keeping land, which is obviously a piece that needs to go into their formula, they just want to build and sell homes. And so Walton is feeding the public home builders land. So what we're seeing is that the builders that are doing the best are the ones that are able to really scale their operations, build houses faster, build to the demographic shifts, and lock in their land positions. They're doing just fine. They do have to offer incentives to keep the pace going, but they have, pace over price right now, and it's working for them.
So, of course, you mentioned that you land bank for public home builders. What's it like on the land side when you are trying to get proper land from landowners? Is there a lot of opportunity there right now?
Well, it definitely is. Just like we look at these national numbers that come out, it is very regional. So starts for new homes are up 12.9% year over year. Starts in Southern California are down 30% year over year. And that's because insurance prices have gone through the roof. You've gone from $3,000 per house to $17,000 per house in some cases. Just they make it very difficult to get projects off the ground. They're now requiring, in some cases, commercial sprinkler systems in residential homes. That just doesn't make the numbers work. So Southern California is on sale just because it makes it's difficult to get projects off the ground. You can get a 3-bedroom house with sweeping views in Malibu for 1.4 now, just because of the fires.
How much is insurance? Is it because insurance costs? It's uninsurable essentially.
It's just because insurance costs have gone up, and builders are really shying away from all of the red tape that you have to go through in that market. So land, it takes a long time, where even we're seeing fix and flippers go from, flipping homes to now they're actually taking down land positions and building homes. You can build for $125 a square foot, sell it for $250 a square foot. The numbers work, but that's not in all markets. In Seattle and Portland, where it takes a year to get your land zoned, you're just going to be, paying your lenders too much money to sit on that land. So in places where it's easier to get zoning and they can go much faster, which is the legal right to build on the land, like Texas, Florida, the Southeast, those land positions are really valuable.
Hey, very quickly, just go back to Malibu, because as a Californian, my head is still spinning. This is one of the areas of the world the real estate is historically has been the most expensive. Repeat the deals you can find in Malibu right now.
Yeah, so sweeping views of the ocean, 3 bedrooms for $1.4 million.
Unbelievable. Okay.
Well,
go ahead, Norah.
I want to quickly move over into commercial. When we think about commercial real estate, everyone tends to think immediately of office landlords. I cover publicly traded office REITs, and office REITs only make up about 3% of REITs more broadly. But what is the appetite like? What is the demand right now in terms of securing land for commercial properties and offices more specifically?
Yeah, I would say it is very choppy. And again, it's regional, where you're seeing landlords that are still sitting on, 50% vacant. They're trying to repurpose, they're trying to renegotiate with the bank. So if you can be in the best location where the office is strong, which is not in a lot of places across the country, then those are going to be more desirable.
And what about other aspects of commercial real estate?
Yeah, I would say data centers. We also own a lot of land where we're selling to data center developers. And so that's clearly a hot topic. And so we're, trying to find the data center numbers pencil, but you have to have the energy and the zoning available to make those numbers work as well.
When do you start seeing pushback from folks who are saying not in my backyard when it comes to these data centers? I know we're already seeing that, but when does that make building one of these just impossible?
Yeah, at some point you just have to keep going farther and farther out to where you're not building near where it's going to be affecting people. So you build farther out, and in Texas, where Walton owns almost 40,000 acres of land, there's plenty of land to build on for data centers where you're not going to have that NIMBY mentality.
Just 20 seconds, the most important place that investors should look regionally right now when thinking about land.
Yeah, I would say the Midwest and the Northeast are performing the best as far as home price appreciation and starts. And the West, Northern California is really struggling. Okay,
there it is. Katie Hubbard, always love talking real estate with you. Katie is Executive Vice President of Capital Markets at Walton Global. It's the privately owned asset and real estate investment company. Taking a look at where equity markets are just a little over an hour from the close of trading today. The S&P 500 down close to 0.2%. The NASDAQ still in the green by 0.1%. The Dow down by 0.6%. Coming up next, it's Stocks on the Move. This is Bloomberg.
This is Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
It is Bloomberg Businessweek Daily. That is Norah Mulinda. She's in for Carol Massar this week. And what a week it is going to be, Norah. We have a lot of data coming in. We've got durable goods tomorrow. We've got Nvidia earnings on Wednesday. Jobless claims, a check of GDP on Thursday. We get core PCE and University of Michigan sentiment on Friday. Yeah, and that does not even to mention the data that we got already today. It's because, Jay Powell was done.
Right.
Now comes all the data before the next meeting.
Absolutely.
That, I don't know if it changes the picture with September's meeting. We'll see.
Right. And I think that's what we've been hearing from a lot of our people that we've been chatting with today. What does the cadence look like moving forward, especially because we do know that a lot of traders are all but pricing in September as the first rate cut that we're going to be seeing upcoming. But what does it look like after that? That's really the question here. Yeah, it is a question. And it's a question, too, that I think a lot of people have when it comes to corporate earnings. As we mentioned, Nvidia stock is a big mover. It represents 3% of global market cap. We're going to bring you all of the latest headlines and analysis with our Nvidia coverage.
happening just after the bell closes on Bloomberg TV and radio. Do not miss it. That's Wednesday. Nvidia earnings coverage, our special coverage of Nvidia's report. Let's take a look at some stocks on the move today. I'm Tim Stenovec along with Norah Mulinda. We're joined by Bloomberg News cross-asset reporter Denitsa Tsekova. Denitsa, what is on your radar?
Let's start with the news of the day. Keurig and Dr. Pepper agreed to buy JD Peet's for $18 billion, but we're not getting quite the reaction they were hoping for. Ticker, of course, is KDP, and shares fell more than 10%. This is the biggest intraday drop in more than 5 years. So the company will pay 20% premium over the closing price of August 2022. What we're seeing here is Keurig plans to separate its coffee and soft drinks unit in two parts. This is kind of undoing the 2018 takeover they had of Dr. Pepper. But what people are worried about is S&P analysts are warning that they may cut the company's credit rating due to plans to significantly increase its debt. Hence the reaction we're seeing. Obviously, the coffee business has been struggling a lot. We have high bean prices. We have a lot of volatility there. Other beverages have been doing better. Hence, maybe the split in two businesses makes sense. That said, Keurig is down 3% year to date. A lot of pressure.
Yeah, definitely seeing a bit of pressure there. Let's look at shares of Roblox. What's going on there with that company?
That's an interesting company. Shares jump as much as 8.5%. It's a little bit lower now, but it comes off a Wedbush defending the stock amid legal threats. In the last few weeks, we've seen 7 complaints that have been filed against the company. The suits claim that predators are targeting children. Wedbush is actually seeing that Roblox continues to be quick to respond with meaningful actions and is seeing optimism. They go as far to say that this is the most compelling growth opportunity in the video game sector, and clearly the stock is reacting to that. Roblox actually has 25 buys, 7 holds, and 4 sells, so there are a lot of other optimists among analysts.
All right, and finally, you are watching Olaplex Holdings. They do the hair care firm that IPO'd last year, I believe.
A few years back. And
has it been a few years?
Yes, it's been a few years back, but it's been a few
flies.
pretty tough years. It was down 32% last year. It's down 10% this year. But today, we're seeing some relief. The company is up about 12%. It's coming off a Canaccord Genuity turning bullish. So what they're seeing is that the hair company is seeing some brand reinvigoration. They hired some executives from L'Oreal, Nike, so that's one boost. The brand is finally seeing sales and margins stabilize. So we're seeing some optimism. That said, this is the only bullish analyst on the stock. The ticker is OLPX, and as we said, it's had a pretty rough start of the year, pretty rough year last year, and we had this great story about how Olaplex was like a social media favorite, and then it turned into like a TikTok disaster.
Because everyone was talking about the fact that they were having scalp issues, hair loss, and all these other things, but then there was also some anecdotal evidence that people were leaving the products in their hair for too long. And so that's also what was causing some of those issues. But they were facing a lot of lawsuits there.
Social media.
I have to correct myself. This IPO'd in 2021.
Yes, it's been a while.
Where is the time gone?
I know.
We're blinking.
It seems like it was months ago that this IPO'd.
I know, but it hasn't had a single positive year. Every year it's down.
So now Canaccord Genuity is the only buy rating on the company's stock.
Only buy rating.
Shares are down 92% over the past 5 years.
Okay, it's been pretty brutal. So a rare day of green for Olaplex Holdings.
For sure.
Bloomberg News cross-asset reporter Denitsa Tsekova with today's Stock Mover. For more conversations like this, check out our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. You can listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Speaking of stocks that are moving, the indices are green and red. The NASDAQ Composite up 0.1%. The S&P 500 down 0.2%. The Dow down 0.6%. If you are sticking with us on Bloomberg Businessweek Daily, if you're watching us on YouTube, Bloomberg Originals, or listening to us on radio, we got a big show coming up. Deals. The flurry of M&A. We're talking about another take-private deal for Thoma Bravo, Dr. Pepper going after Peet's, and Elon going after Sam Altman. All that and more next on Bloomberg Businessweek Daily. If you're sticking on TV, the close starts now.